Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Dan Ives, Senior Equity Analyst at Wedbush Securities, covers all things technology. Hey, Dan, let's start with the Apple news that just came across the tape here, a little bit delaying or halting temporarily, at least, some of their watch sales in the U.S. What do you make of this news? Again, it stocks off about 1.3% today.
Yeah, I mean, look, there have been some issues on the Apple Watch side, and a lot of it is really around models in terms of what they're trying to drive. I view this as just a small bump in the road, but I actually think watch sales this holiday season are going to be up double digits. So I view this as sort of noise relative to the broader story.
And I was informed that you are at the airport, so for our YouTube audience, unfortunately can't see Dan right now, but usually he's got the pastels on. Paul knows what I'm talking about.
Yeah,
but
he needs some help on that.
So we're disappointed there. But when you have a stock like this, obviously back around that $3 trillion market cap threshold, trading around records in news like this, kind of break down to us, does it make sense to you? Because you'd think, I mean, the stock's only down, I think, a little more than 1% at this point. Is it just kind of a reason to sell a little bit here?
Yeah, and Jess, in my opinion, this is the start of the next phase of the Apple growth story. Because essentially what's happening now is services is upticking, despite some of the news coming out of China. I saw Bloomberg report it, which is obviously overall headwind. China is actually resilient as overall demand. So when you put it together, I think a year from now, still in pastels, I think we're looking at a $4 trillion market cap.
So, Dan, give us, I don't know, your latest thinking on just China in general, because arguably there is no company in the world that is more exposed positively and potentially negatively to China, both as a customer and as a source of product. How do you break that down for your clients?
Yeah, look, I think, and someone like myself spends so much time in the region, you got to separate between headline risk and what's really happening in the market. I think Huawei and what we've seen in terms of cold tech war between U.S. and China, yeah, it's an issue. But there's 100 million iPhones in China that haven't upgraded in 3 years. So the demand continues to be strong there. And I think when it comes from a production perspective, they'll diversify some into India. But the reality is next 2-3 years, I mean, that's not going to significantly change. That is the hearts and lungs of the Apple story, supply and demand.
And Dan, we know you're arguably biggest bull on Wall Street when it comes to technology, but what do you think is the biggest risk to your bull case in the shorter term here?
Look, I think the biggest risk near term is China. It's not the numbers. It's not Fed, despite the poker game. Everyone knows you're going to have cuts in 24. That, I think, creates really this Pillsbury Doughboy soft landing. I think it's really the China story. It's the geopolitical, but that's also why a lot of the bears that have been in hibernation mode through all of 2023, they're starting to come out of their caves a little and look at this market, because I believe it's the start of this new tech bull market.
Hey, Dan, I guess AI, as we think back to 2023, AI was certainly a theme, certainly the tech theme. As we look forward to 2024, is there something else out there? What's the theme for 2024 in your mind?
Yeah, Paul, I think it's really use cases, because if you follow the breadcrumbs, follow the use cases, you'll find the treasure. So the use cases are really what's going to drive next leg of growth for Microsoft, for Google, for what we see with the godfather of AI, NVIDIA and Jensen. And then you have some of the pure plays like Palantir, MongoDB, and others. And I think it's actually a year from now, it's going to be the rest of tech. The rest of tech joins this party. I still view it from a tech party. It's 9:30 p.m. It's not 2 a.m.
Ooh. So walk us through Tesla. You had a note that came out at the end of last week talking about how Tesla battled with unions in Scandinavia, now on the radar for the street. You do have a 12-month price target around $310. Currently trading for Tesla right now, it stocks around $257. Walk us through what you're seeing with Tesla here and what you see moving forward.
Yeah, I mean, look, I think when you look at deliveries, feel de-risked for Q4. I think we're seeing a good China number. And I think that's something, there's a stock that's going to probably move higher in the next few weeks going to deliveries in early January. Now, look, with the union issue, it's a UFC battle, a WWE. I mean, they're starting to see it now in Scandinavia. It was Sweden originally. Now it's gone to Norway, Finland, Denmark. The worry here, you give in here, then UAW, Sean Fain, they watch this carefully. So you can't give an inch, you give a mile. And I think that's why this battle is so important, because I think there's better chance of me playing NFL playoffs than Tesla having union workers.
Wow.
Yes, that's right. Hey, so Dan, one of the things I'm trying to wrap my head around is, again, AI. I guess I'm there. I was, a little bit, I don't know, just cautious, skeptical at the beginning. I guess what would help me get a little bit more on board is I can go back and look at the IDC technology spend over the last, number of years. How much of that going forward incrementally will be AI versus, just tech spending growth in general?
Sure. It's a great question. I think actually it's a phenomenal question because it hits the crux here. In 2023, we think less than 1% of budgets were AI. 24, based on our analysis, 8 to 10% of IT budgets will be AI driven.
Wow.
That's why it's the lotto ticket for those companies with the use cases, software, chips, services that go into that market. And I think it's all use case driven. 80 use cases today. 3-4 months ago, you had less than 20.
We've talked so much, and especially analysts on Wall Street, about the productivity boom potentially when it comes to AI. Walk us through what you think AI skills are and how employees can acquire them.
Well, I was at a conference speaking a few weeks ago, and it was more of an accounting conference. And, there, my suggestion is, for anyone on the account, it's really going to be developer language, whether it's Python or other. I think you're going to see more and more from a developer language perspective starting early, that you're going to see more starting to take that over as another skill set. Because if you understand AI in the developer language as more of these functional areas, finance, marketing, within hospitals, within healthcare, it's going to just from a skill set perspective make you that much more valuable.
Do you think it's not necessarily then just the stereotypical STEM type careers? It can go beyond that.
I think it goes way beyond that. And that's why I just disagree with the view, the whole, it takes away everyone's jobs. Jess, I think at the next 3 to 5 years, it's a job creator when you actually start to look at what's going to happen from the developer's perspective, marketing and use cases. And I think that's why it's so important. It's something we'll be talking about for really the next decade.
All right, Dan Ives, thank you so much. We appreciate that. As always, Dan Ives, he's a managing director, senior equity analyst, Wedbush Securities, and a huge Penn State fan. He may even going down to Atlanta as Penn State football, the Nittany Lions continue preparations for their December 30th Peach Bowl date with Ole Miss in Atlanta.
I bet we see a picture on
I bet you see him on
X.
social media.
Yep.
Yeah, he'll be out there on the field. We'll figure that out. So, again, it's a little bit of news out there on Apple today about a temporary halt of certain watches starting in a few days in the U.S. Stock off a little more than 1% maybe on that news. Dan Ives' takeaway was not material to the overall story at Apple.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Nippon agreeing to buy U.S. Steel for $14.1 billion, the deal of the day. Brooke Sutherland joins us. She's a columnist covering all these industrial companies and deals, so a great voice to get on that. She's from Bloomberg Opinion, zooming in from Boston. Hey, Brooke, what do you make of this deal? I mean, it kind of feels like I'm trying to wrap my head around the valuation. The last time I had paid attention, Cleveland Cliffs had a $7 billion offer on the table. And now $14 billion. Where did that come from?
It is certainly a very robust premium. I mean, I think that underscores the value of these assets, especially in the context of the sheer amount of investment we're seeing in the U.S. in infrastructure and also in factory construction. You need steel to make all of those things. U.S. Steel has also been pivoting toward greener production strategies. All of that is very valuable, and these are scarce assets. There's not that many big steel companies left to purchase. And for Nippon, the ability to gain a really strong foothold in the U.S., I think, is what's really driving this premium here. But it's certainly a significant step up from what we were talking about in August when Cleveland Cliffs lobbed in its initial bid. And I think that's why you see Cleveland Cliffs out this morning congratulating U.S. Steel on this deal and wishing them luck. I think that economic gulf is just far too wide for them to be able to close.
If you look at U.S. Steel stock, ticker symbol X, up about 26% on pace for its best day since August 14th of earlier this year. You look at Nippon, it's actually down about close to 5%. So is it fair to say if you are a U.S. Steel shareholder that they're liking this deal?
I mean, sure. I don't know what there is to not like about this deal if you're a U.S. Steel shareholder. It's normal for, stocks of the acquirers to go down on the announcement. I mean, I think the biggest question as a U.S. Steel shareholder is what the U.S. government is going to think of this deal. On the call today to talk about it, executives said they did not foresee any issues from a CFIUS perspective, although, of course, this will get a review with a foreign company buying a U.S. one. I think that it might be slightly more complicated than their answers on the call suggested. This is a very politically charged industry. It was not that long ago that we were slapping tariffs on steel imported from Japan as a quote unquote national security issue. And so I think this is going to get a lot of scrutiny. We already had some comments from politicians, back in August when this kind of first came under, the prospect of a deal was being talked about. A number of politicians said, we do not want to see U.S. Steel sold to a foreign company. And obviously that is the announcement that we're getting today. And so it's going to be interesting to see what happens with this. Now, I will say, there's been a number of foreign companies making investments in the U.S. spurred by the incentives included in the CHIPS Act, included in the IRA. Those have been cheered by the Biden administration. And from a practical standpoint, if jobs are being created and factories are being built, does it really matter if it's a U.S. company or a U.S. subsidiary of a company that's based in a country that's a strong U.S. ally? Maybe not, but politics can be very prickly.
How about the unions, Brooke? I know the unions are a very important voice in these deals. And I believe the union had supported the Cleveland Cliffs offer. I'm not sure about this one.
No, the head of the unions made some comments to Bloomberg News this morning in the interview that the notice on this deal was rather short, and they were not involved in the communication leading up to it. And so it will be interesting to see, what tactic the union takes if it doesn't like this deal. I don't know what avenues they have to push back at this point. They'd said they were willing to transfer their right to counterbid to Cleveland Cliffs. But as I mentioned, Cleveland Cliffs is out this morning congratulating U.S. Steel on the deal. They do not look like they are gearing up to try to challenge this offer. And the difference between what Cleveland Cliffs was offering and what Nippon is now offering is very wide. And that would be a very tough gap to bridge. So I'm not entirely sure what the union can do to block the deal at this point.
So any sort of regulatory hurdles?
Yes, like I just was talking about with CFIUS, I think that's going to be a key one to watch.
So there's nothing like, can you actually explain CFIUS to me? Because I was just going to ask about DOJ or FTC, but maybe there's a different body here. So explain the CFIUS review.
Sure. So CFIUS gets involved when there's a foreign company acquiring a U.S. asset. And so they tend to review deals from a national security perspective. So it's a different process than what we typically see from the antitrust regulators. There was some question about whether a Cleveland-Cliffs U.S. Steel combination would raise antitrust red flags. I don't think that's the primary concern in this case, as Nippon does not have a particularly robust presence in the U.S. already from a steel perspective. So the question is really going to be, are we comfortable with letting a foreign company own this U.S. asset? Obviously, Japan is a very important U.S. ally. It is a very different question than if there was a Chinese company trying to come in and buy a U.S. steelmaker. But I still think, just given the environment that we are in politically and all of the scrutiny over ownership of important American assets, that this is going to get some scrutiny.
Do you foresee additional M&A happening in that particular industry group on the back of this?
Never say never. I mean, anytime you have a big deal like this, it tends to get people thinking about what other possibilities there could be. But this is already a very consolidated industry. And so I think to see much more consolidation happen would be difficult. And then you do start bumping up on questions of antitrust.
So explain to me, Brooke, I know one of the growth areas of U.S. Steel is, I think they have a new plant, maybe in Arkansas or something. Can you talk to us about that plant and that technology?
Sure. And so it's a greener technology. They use sort of more recycled materials. This is sort of considered the future of steelmaking. And so that's obviously a very attractive asset for Nippon. And, these companies talked a lot about on the call about sort of their shared commitment to decarbonizing, about investing in R&D and new technologies to try to improve upon the steelmaking process. And so that's certainly one of the key drivers of this acquisition.
And when it comes to something like this, especially if you're thinking about steel and what that means for the global economy, as far as the position that these two companies are in, what do you think this tells us about the global economy if these two are potentially merging here?
Sure. I mean, I think it's a vote of confidence in the U.S. manufacturing renaissance or revitalization of U.S. supply chains, onshoring, whatever you want to call it. It's a narrative that's taken some hits recently. If you look at particularly in the EV sector, there's been a number of companies sort of pulling back or delaying some of the investments that they've announced. And, that sort of just does raise the question of, okay, well, what does this onshoring boom actually look like? And this is something that I've written about a lot, is I think that, there was a lot of enthusiasm around this, partly because of the government stimulus, but this was never going to be sort of a clear and streamlined timeline, that there's a lot of variability here, a lot of pushes and pulls. This is not something that has, managed to separate itself entirely from the broader economy, that companies are still sort of subject to those economic forces, but there are underlying tailwinds here that are driving investment. One of which, of course, is the stimulus funds. Another is, the lessons learned from COVID, but also, the tariffs under the Trump administration, that it's very valuable to have a U.S. supply chain and not be dependent on having to ship goods from across oceans. And then, the energy transition, things like that are very strong underlying forces that I think will ultimately lead to more manufacturing in the U.S. It just may not happen on the timeline that we might have been hoping for.
Brooke, thanks so much for joining us. Brooke Sutherland, columnist covering industrials and deals for Bloomberg Opinion. Again, Japan's Nippon agrees to buy U.S. Steel for $14.1 billion. And of course, I go check out who the bankers are.
Right.
The M&A bankers. Citigroup is acting as financial advisor to Nippon Steel. Barclays, Goldman Sachs, and Evercore are advising U.S. Steel. So it's a good deal to get announced before year end. Two, global iconic names, particularly U.S. Steel, but Nippon Steel's been a big player globally for a long time. So good M&A trade to get on your sheet right before year end. You go talk to your boss, but they'll be working over the holidays, papering over this deal.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Penny Foley, Managing Director for Emerging Markets for TCW, joins us here in studio, so she gets a special gold star there. Penny, how can I play emerging markets when my biggest emerging market is China, and I have no idea what's going on in China? How do you guys think about that from a 30,000-foot level?
Well, we focus obviously on fixed income. China is actually a relatively small part of the index.
Okay.
It's about 4%. And we're typically, that's the dollar index, and we're underweight China.
Okay.
We use corporates to some extent, which are pretty defensive, shorter maturity, higher ratings. So that would be how we play China in the dollar market. In the local currency market, we've used China as a funder, largely low. It's at low yields. The currency's been relatively stable, so that for us is a funder. If you look at EM as a whole, the growth rates this year have widened relative to DM growth rates. We expect the same in 2024, and that excluding China. We expect growth to really remain pretty much the same from 23 to 24. So I think the fundamentals are pretty attractive in these markets. If you look at the world from a debt perspective, debt peaked at about 62, this is excluding China, debt peaked at about 62.5% in 2020. We expect it to be about 56% by the end of 2024. There was a lot of concern about defaults at the beginning of 2023, and that concern continues. There are about 17 countries in EM that don't have access to the public markets, so those are clearly candidates. Of those, 8 have maturities in 2024, and we expect 7 of those will be able to make it through with funding from the IMF and other sources, local markets as well. The only one that is at risk is Ethiopia, which obviously just announced their intention not to pay.
How do you view emerging markets that are commodities-driven emerging markets versus the rest that aren't as closely tied to commodities as far as what their economic outlook looks like next year?
I think that one of the things to think about in emerging markets is the index today for EM fixed income is about 70 countries plus. So they're all over the place. It used to be back in the old days when you could just say this is a trade where we're going to have compression of spreads, and everybody was pretty much in the same area. We had 10 countries in the index in 2000. You had 30 in 2008, and you have over 70. So it's very much a game of differentiation. And so in our strategy, we're about 40 countries in that. So we really are ignoring about a third of the index. And there are countries that are in the portfolio because we like the local story, and Mexico and Brazil are two that benefit both from local story as well as in the case of Brazil is commodities, and in the case of Mexico, it's really nearshoring into the U.S. So those are two countries we like very much.
What else besides those? How risky do you go out in your kind of profile for emerging markets?
Well, I think one of the things that is particularly interesting about EM is those countries that are, that have tried every bad idea in the, in the book, and they run out of options. And that's what we call a significant turning point. And that can be driven by just hitting a wall. It can be driven by a change in administration. Argentina is a good example right now of a country that could well come out from a couple of decades of bad management to a better environment, and it's it's still relatively cheap.
So how are you positioning for Argentina, for example? Because that really was in the news most recently.
We're overweight Argentina pretty significantly. We have a strong EM Latin America strategist he's Argentine, and he suffers from a negative bias.
Right.
But he's been very positive about Argentina and the outlook under the new administration.
You look at some of the data under Bloomberg Intelligence, so Gina Martin's Adams team, they're looking more at what happens with the equity side of things, but especially looking at how emerging markets are definitely primed to lead when they're looking at some of their global counterparts, just because, especially from an earnings perspective, they have gotten hit hard in the past few years. How do you view that going into next year when you're looking at emerging markets versus other countries globally?
Well, I think EM went into a downturn a little earlier than the developed world,
right?
And they're coming out a little earlier. They started to increase rates really a year before the developed world, and they're in Latin America and in Central and Eastern Europe, rates are coming down. We expect that to broaden out over the course of 2024. Inflation is coming down faster than it is in the developed world. So right now you have about a third of countries that have services inflation pre-pandemic levels, and 2/3 goods inflation pre-pandemic levels.
So you mentioned Central and Eastern Europe, and of course, a lot of geopolitical risks there that you and other emerging market folks have to deal with. How do you think about that part of the world here? Is it just too risky given what's happening in Ukraine?
No, we are neutral, the region overall.
Okay.
The CE3. We've taken our overweight in Poland, which also is going through a government transition, which could be positive. Mm-hmm. And we're less excited about some of the other countries in the region, which are going, in our view, in slightly the wrong direction.
There's been so much debate about the Federal Reserve potentially having to maintain a hawkish stance, even on the back of what we obviously heard from Fed Chair Powell last week, and these Fed officials that have been coming out, leaving the door open to those potential rate cuts in the second half of next year. But when you're looking from a global perspective, do you see anything, even in particular with emerging markets, or anything going on with inflation that you really feel like is a risk and could end up sparking potentially further downside risk to the global economy that maybe investors are underestimating?
I think the biggest risk on the inflation side is really commodity prices and conflict that generate higher commodity prices. Russia-Ukraine obviously shot food prices up substantially. That's come down a little bit since then, and on the conflict in the Middle East has yet to have a major impact on oil prices. But those are two major risks, and oil and food are very heavy weight in the EM inflation basket, close to 50%. So those, I think, would be the big risk.
What areas or situations are you guys avoiding the most? Where's your highest conviction of, like, we just cannot be in this part of the world?
Well, we're pretty much in all parts of the world.
Okay.
Turns out. Right now, we're overweight Latin America, and we're overweight Sub-Saharan Africa. We're equal weight in CEE and also in the Middle East, and we're way underweight in Asia. We find that less interesting at this point.
Underweight in Asia.
Underweight in Asia. We find it less interesting at this point, just in terms of rates are lower. They have less duration opportunities there as well. So our big positions in Asia are Indonesia, India in corporates in the dollar side, India on the local currency side because of its inclusion in the index going forward, and Korea also on the local currency side in expectation for a better external environment and also possibly being included in the WIGB.
We only have about 20 seconds left, but what's the top question you get from your clients?
Well, interesting enough, we're now getting one of our top questions is when do we get involved? If you look at the technicals, we've lost something like 115 billion outflows since the beginning of 2022. So there's most people in my seat are either neutral or underweight, and there's very little tourist capital in our markets. So I think the technicals are really supportive going forward. And in terms of issuance, we expect issuance to be largely IG.
Okay, very good. Penny Foley, thank you so much for joining us. Penny Foley is the Managing Director, Emerging Markets for TCW.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I've been long saying that it just seems to me for the next generation, one of the really big growth stories is going to be cybersecurity.
Yes,
I mean,
it is.
You can't go wrong there. Everybody's got to spend money to,
That's right.
protect their networks. I'm looking at Palo Alto Networks here. Stock, it's a $97 billion market cap stock. I guess the market agrees with my assessment. Stock's up 120% year to date. So Wendi Whitmore joins us. She's the Senior Vice President and Head of the Cybersecurity team at Palo Alto Networks. But her highlight of her resume is she's on Duke University Master of Engineering and Cybersecurity Industry Advisory Board. That's a mouthful, but anybody who's associated with Duke can stay. Wendi, can you tell us what Unit 42 is?
Absolutely. So great to be here. Unit 42 is really the eyes and ears on the ground for all of Palo Alto Network. So we are the special forces unit, if you will, that really responds on the ground to all of our clients' situations. So oftentimes that's helping them in their worst day, everything from responding to breaches to doing the research and analysis on the front end to understand what cyber attackers are doing, and then threat hunting on nodes throughout the world to identify the latest and greatest attack patterns.
Well, there were a number of big cyber attacks this year alone. Why do you think this is, and will they continue to escalate?
Unfortunately, they absolutely will continue. I think you mentioned it, cyber is really the story in terms of a major industry moving forward. The reality is right now, there's a lot of money to be made by attackers in the space. So what's happened is we have major geopolitical activity going on throughout the world, right? Every region from EMEA to certainly in the Asia Pacific rim as well. And so when you have that occurring, you oftentimes behind the scenes have nation state actors continuing to propagate activity even more. And so we're seeing that. What we're also seeing, though, is a combination of cyber criminals becoming more sophisticated. Again, this relates to money being made. And the reality that there's a lot of money to be made in the space, but cyber criminals in particular really understand how businesses operate, their level of interconnectivity between B2B type of markets, and they're taking advantage of that as we speak.
So, in 2023, one of the investing drivers here was AI, artificial intelligence, and first time I kind of heard that, I was like, oh boy, you put AI together with criminals. How bad can this get? So how do you guys at Palo Alto Networks, when you talk to your clients, how do you frame out AI as an opportunity, but as also a risk?
Absolutely. So I think with any new advancement in technology, there are pros and there are cons. On the pro side, we have leveraged AI, in particular precision AI, as well as machine learning, to advance our technologies and detect these attacks. And that's been going on for years. But what we've seen over the past year in particular is the advancement of generative AI. And that is obviously enabling a lot more effective human communications. And that's everything from written to verbal, and in some cases, video. So we think from a defender perspective, there is a whole lot of great things that we can leverage from Gen AI, and we're doing that today to advance our analysis, to make sure that we're leveraging our human resources for the most difficult problems and automating as much as possible on the front end for our machines to solve. That said, the attackers are also doing something similarly. What we're seeing today is their use of heavy reliance on the communications piece. So whether that's in crafting spear phishing emails or communications on the written side, or in some cases, whether that's impersonating verbal communications to circumvent employee identity verification so that they can break into an environment. We're seeing the full spectrum.
Talk to us about this new SEC ruling and how it relates to cybersecurity.
Well, so we're seeing increased regulation across the board, right? So what we're looking at from the SEC is an emphasis for reporting from individual organizations. I think the challenges are in terms of timeframes. Oftentimes, the least, and not oftentimes, always, you know the least at the beginning of an investigation. And so those first 48 to 72 hours to weeks are really where we're identifying a lot of information, and it can be very dynamic, right? It is changing constantly. One thing that I think we're seeing that's really interesting coming from the SEC notification is the fact that attackers have now, and again, we're talking about cyber criminals, not nation state actors, at least not yet, but cyber criminals saying, well, hey, I'm going to use this to my advantage. And if I compromise an organization and they didn't report it yet, I'm going to let the SEC know, and I'm going to file a disclosure notification myself, which is causing, obviously even more headache around the notification challenges.
Wendy, do we know what percentage of cybercrime is by individuals, a couple knuckleheads in the garage, versus nation states?
That's a great question. I'm not sure anyone can answer that completely comprehensively, but I would say a significant amount of the activity, certainly that we see and that our competitors see, is focused on nation state. The difference there is that it often, really runs under the scenes, right? It's not something where these attackers are stealing information and data and then sharing it publicly, right? They are providing it to some sort of analytical capability on the back end so that they can identify information usually targeted against a political objective. That's very different than when you have a cyber criminal who's looking to cause disruption to business, right? We're seeing that today with disruption to retailers, on their busiest period, trying to satisfy orders before the holiday season. And, we see that over the past few months, you saw disruption in Las Vegas in terms of operational impact. People can't check into hotel rooms. Yep. They can't place bets, right? So we see really two different objectives there.
All right, Wendy, thank you so much for joining us. Fascinating stuff. And again, if you think back to the movie The Graduate, plastics as being the future, cybersecurity, right, I think is the future here. Wendi Whitmore, Senior Vice President and head of the cybersecurity team at Palo Alto Network. Do you think she gets some panic phone calls in the middle of the night? Do you think that happens from clients? It's
I would imagine.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.